So these are the 7 bonus tax strategies. They're not exactly related to OBBA. They're more of a teaser trailer than anything else. So we'll talk about, let's say, the real estate holding. There are a lot of things over here. In the real estate holding, the idea is real estate is tangible. People want to invest money into real estate, but a lot of times they don't know the right way of investing into real estate. For real estate, smaller is better. $100,000 apartment can fetch you $1,000 monthly rent, 1% every month. A $500,000 house will fetch you $3,000 every month. A $1 million house will fetch you $5,000, meaning higher the property, bigger the property, lesser return you have. You don't have to live there. So when it comes to real estate, be smart about it. Smaller is better. Then you have to be concerned about 1031 exchange here. When it comes to the real estate investment, you invest, you sell, you have capital gains around it. But if you reinvest this money, then you don't have to pay capital gain. But then one of the clients said, but eventually I have to, I'm just deferring it. One day I have to. But the idea is, the concept is called swap till you drop, meaning you keep exchanging it. Don't sell it, exchange it, sell it, exchange it when your next generation gets it. The rule is at the time of death, when the property goes to the next generation, the property goes at the market value, meaning at the time of death, if your next generation, your kids, sell the property immediately, meaning at the same market value, they pay zero tax. Swap means 1031 exchange till you drop, meaning once it goes to the next generation, so you avoid the taxes completely. A lot of these big billionaires made their money with this strategy. They never paid any taxes. Kept investing to real estate, kept exchanging it, so they did not have to pay any taxes. So we are talking about the asset allocation. People are making money, they keep pushing the money to the stock market, and then they are surprised and they have the large dividend gain or large taxable income. So if you can be cognizant about it, how much money can be invested into 401k, IRA, traditional versus Roth IRA, can you invest into SCP plan? There are a lot of plans around it, especially if you are a solo business owner, a small business. The number of options are limitless that you have. Defined benefit plan, defined contribution plan. So here, I'm not promoting it, but I truly believe investing into ETF or low cost, low load option in the long run turns out better than getting fancy around it. Meaning you can go to the angel investment, you can have the hedge fund specialist, you can have a lot of nifty planners around it. But if you keep it consistent, keep it into S&P or whatever plan you choose, and keep it there, the money is safe over there in the long run. Tax loss harvesting promote when you have, towards the end of the year, in next 2 months, look at your portfolio, see what stocks you are losing money, and if you have capital gains, try to balance it out, where you can sell some of the stocks where you are losing money, so those losses can be offset against the income you have. The system allows you to claim up to $3,000 of capital losses over and above your capital gain. It doesn't matter how hard you try, you still will have to pay taxes. Try paying estimated taxes every quarter. It's April 15th, June 15th, September 15th, and then January 15th. The way the system looks at it, if you owe $100,000, we want you to pay taxes $25,000 every quarter. Not at the end of the year, not on April 15th. If you pay $100,000 April 15th, we'll charge you penalty and interest around it. So you need to know how much tax you will owe, roughly, and then plan it to pay every quarter. That's called the estimated tax payment. There are rules around it. Just be careful. Try to defer the income. Deferring income means putting the money into the retirement plan, where you will take the money out after the retirement, where your income is lesser. That could be one option. Deferring money could also means you say cash business, don't pay me now, pay me next month. Or you give me the check, but I don't deposit it. I'm sitting on the check. You will see a lot of money going into the bank in January 1st week. People who don't pay the bill, they are sending me checks in December. Take the money. I thought I owed you some money. I sent you the invoice 7 times. No, I meant to pay you. And they're sending me the checks in December just to clear it up. And then you can hold on to this thing. You can have the installments and it gets very, very nifty. And I don't have a separate slide for it, but I'll give you an example. Let's say if you are selling a business for $1 million. If you take this $1 million, you have to pay tax on $1 million, right? What you do, take an installment plan for 10 years. Give me $100,000 every year for 10 years. But you don't want to wait for 10 years. You want your money now, but you don't want to pay tax on this. So get an installment plan, take 100,000 now, then this installment plan, which is a legal agreement, you take it to the bank. I have this installment agreement. You can collect the money on my behalf. Just give me the money now. The bank will lend you 70% of that installment agreement. So you got $700,000 right now, and the tax you pay is only $100,000. The concept is called monetizing the installment plan. So gift tax, the question we are asked generally, how much gift can I give to my friend, my son, my children? So the limit is 19,000. But what's misunderstood is if you gift more than 19,000, you don't pay any taxes. You just have to do some, like when you do personal taxes, there is a form, we call it 1040. You fill up this form, that's 1040. There is a similar form, we call it 709 form that you have to file, but there is no taxes if you have more than 19,000 of gift. The other thing you want to understand, the gift obligation belongs to giftor, not the giftee. I'll give you an example and you will remember the concept now. This football player, he won $1 million. Very, very rich guy. So what he does, I'm very happy. This teacher, this academy made me the person I am. I'm going to give all of it. He took $1 million and gifted this $1 million to this academy that made him the player that he was. 3 years later, IRS called up, hey, gift tax, because gift obligation belongs to giftor, the person who is giving the gift. Now this person is sitting on a $300,000 of IRS tax bill with no money, because whatever money he got, he gifted it to somebody else, and it was not a 501c3. It was not a charitable organization. It was the academy that made him the player he was. So he gave the $1 million over there. Now he's obligated to pay $300,000. So just be careful when it comes to these things. So here we have a lot of retirement contribution. There are some plans that can only be implemented before December 31st. You can't have 401k implemented in January. There are some plans that you can do till March 15th. Then there are some plans that you can do till April 15th. But the idea is you have to know what you can do, what you can't do, and what are the time limits around it. Say the limit for the 401k is 23,500, 750 additional one if you are over 50, but it has to be done before December 31st. Traditional IRA can be done till April. This is April. This is December 31st. This is March. Meaning you have to know SCP cannot be done after March 15th. That's the deadline for this. So every plan has a different limit to it and different contribution.